Today, we'll look at a whole life insurance policy that was started about 12 years ago for someone in their late 40s. Today, he's in his early 60s. So I'll go over why he put money in this policy to start with, and then I'll show you how it's performed over the years. So when we connected and he started his policy, he was 49 years old. And he was interested in life insurance, not so much for the life insurance. It was mainly the cash value. So firstly, it was a safe place he could put some of his money with tax advantages. He was really interested in that. The second reason he put money here is because he wanted to be able to use it as his own bank. And he's done that a lot over the years. He invests in real estate. He also has a small company with a few partners. But one of the first things that he did that I thought was really, really cool is he bought a townhome and he worked on that as a project with his son. And he used money from his life insurance policy to do so. And that just gave him a lot of flexibility in terms of how and when he pays it back. And then the third item really has to do with the life insurance itself, which wasn't the driver in terms of why he put money here, but in terms of leaving wealth to the next generation and making sure that his kids are well set, his grandkids are well set, and they can also use that money for real estate, for the family business. That's also appealing to him. So let's take a look at the actual results. I'll go over exactly what he did. So with his policy, he started out by funding it quite aggressively. For the first 4 years, he put $150,000 into the policy. That's per year, by the way. And then what happened after that, you'll find he scaled the funding down to $50K, then to $35K, then just the minimum, which was about $15,000. And for the past 3 years, he's paid zero, and he doesn't plan on adding anything else to this policy. He just wants to borrow, repay, use it like his own bank without any obligations to continue to add more money. So as we look at the policy, what we've got here are the annual statements, which I really just have up on the screen to validate that the numbers I'm about to show you are real. These are from his actual annual statements over the years, and this is how we track the performance of life insurance policies for all of our clients. Looking at his policy, here we go. Here's exactly what he's done over the years. So he started in 2015, and you can see the funding of $150,000, and that went into the policy for 4 consecutive years. Then you see it's reduced. In the 9th year, he funded just about $15K. That was just his minimum premium. And for the past 3 years, he's paid nothing. So the values you see here, again, are his real results. This is why we're only looking at the first 12 years, because this is everything that has happened to date. I'll show you the projected values moving forward in a little bit. But as we look at this guy, what do you notice? Well, firstly, why everybody hates whole life insurance is typically because of the upfront hit. But you can minimize that, like we did for him. So he funded $150,000. The first year cash value was $128,000, which is about a 14% loss. We've got the annual yield, which represents the net growth rate on a year-to-year basis, meaning if he asked, hey, what did I earn this year? And we go down to this year, 2026. My answer would be, well, last year, you were at 1.83 million. You paid zero, so all of your growth is just based on what the insurance company gave you. It grew to $1.143 million. So if we crunch the return there with a calculator, it'll come out to 5.61%. That's the annual yield, the net growth rate on an annual basis. We're isolating 1 year. The IRR really gives you the long-term average because we're factoring in the early years as well. So when we look at this guy, to date, he's at about a 4.2% IRR, which if you've done any research around whole life insurance, you know that that is very attractive for 12 years into a whole life insurance policy. Some policies are still negative by year 12 or have a 0% IRR. So that's very strong, and that's mainly because the policy is set up with minimum premium costs and it's set up for maximum cash value. The death benefit is at $4.2 million. The reason why is because that was as low as we could set it at the time to prevent a modified endowment contract. So when you look at the cash value benefits just of whole life insurance in general, grows safely, it's very liquid and easy to access, and then if we follow IRS rules, we can access it tax-free, which he has been doing through loans and such over the years. Now, any life insurance policy can become classified as a modified endowment contract, and if it does, you can't access the cash value with the same tax benefits. If there's any gain, you've got to pay income tax on the gains, and if you're under the age of 59 and a half, you've got to deal with a 10% penalty tax. People don't want that, nor do I. So the death benefit of 4.2 came from the need to prevent that MEC from occurring. Okay, so before we look at the projected values, a couple things that he has expressed that he's really liked about this policy, and I've talked about this quite a bit over the years, is look at this. This was COVID, where everybody felt like this during COVID, especially in terms of what was going on with the market, the interest rate environment. The market dipped hard and then it rebounded, but there was so much uncertainty going on at the time. He's never been a big stock market guy. He just had that consistent growth in a very, very low interest rate environment, by the way, just producing almost 5% per year, plus the tax benefits that come with the policy. So it gave him a lot of peace of mind with his money, which he really appreciated. And then for the past 3 years, he's funded nothing. He doesn't plan on doing that anymore. And to date, he has funded $770,000. So how I like to look at this is, if this is me, I put in $770,000. I have $1,143,000. So I've got a significant gain there. I got a lot of value and I've been using it along the way. The death benefit is $4.2 million. And that's today. If I look at the runway here, so this is based on an in-force illustration. These are obviously not actual results moving forward. It's a projection, but we'll track it over time. Let's assume he kicks the bucket at 85. I'll say 90 because he received an ultra preferred rating, which means the insurance company thinks he's going to live for a long time. That's what it means if you get the best health rating. So there you go. Death benefit has appreciated to $6.4 million, which is paid income tax-free to his beneficiaries. And a lot of times what we see with people who are into the idea of creating real lasting wealth is, instead of having that go directly to the family, they may have it go to a trust. And then I put specific rules in that trust that stipulate who can use the money, when they can use the money, what it can be used for. I might want some of that money to be used to purchase additional life insurance policies on the family members, just to create a perpetual wealth system that just keeps on snowballing and putting more money in the trust. I can keep it in the trust if I don't want it to go directly to a family member, because I'm concerned that a family member might not be responsible enough yet to handle a large sum of money. There's a lot of different things you can do. But when you look at families who are concerned about building lasting wealth and they want their family to always be well set, life insurance is almost always a critical part of the plan. And most families that have done a very, very good job in creating perpetual wealth almost always have life insurance in that plan. Different forms, different types, but it is very, very common because of the tax advantages of the death benefit and, frankly, the cash value as well. Anyway, I hope you enjoyed this video. I would love to hear your thoughts. Please let me know in the comments below. And as always, I hope this helps. So if this was helpful and you'd like to go deeper, here's what I would do next. Step 1, download the free case study using the link below. It'll make everything we talk about feel more concrete because you'll see actual numbers on paper. And step 2, if you're serious about a high cash value life insurance policy for yourself, whether it's for your business, real estate, or you're just looking at a safe place to save money with tax benefits, I'd use the calendar link on that page to book a custom policy design session. On that call, we'll ask a few simple questions about your situation. We'll go over an illustration with you on the spot, and we'll walk through the year-by-year numbers so you can decide if it makes sense for you. No pressure, just math and options. And if you just want to keep learning for now, feel free to subscribe and check out the other case studies on the channel. As always, I hope this helps.